Hi guys, and welcome back. We are now on video 2 of chapter 7, and this is it. This will be the last video here. So economic profit versus accounting profit. If you remember, accountants only measure explicit costs. We see it here as total costs because this is what you will see on a spreadsheet. You will not see implicit cost, which is the opportunity cost, anywhere on any spreadsheet. Economic profit, on the other hand, does allow it. So a company that wants to see if they're compensating for the, could have made it but didn't, the opportunity cost, will have to look at their normal profits. Economic profit is also known as normal profits, which is zero economic profit, in the sense where the total revenues have to pay back the total costs and the implicit costs. So if we look at this one, it didn't. So the only way for this company to have reached zero economic profit, to break even, while factoring in for the implicit cost, then this firm needed to make at least $17,000 in revenue. So even though they shut down, remember we were discussing the shutting down, we were here on this slide right here, and we said, imagine you have to shut down for a bit and have a cleanup cost of $5,000, and we said to an accountant it's $5,000, but to an economist it's $17,000. It's the $5,000 of the actual cleanup and the loss of $12,000 in sales. They didn't actually lose anything, but they didn't make it, therefore it's an opportunity cost, therefore it's an implicit cost. So we go back over here and we say, okay, let's say there's revenue of $9,000. This company, according to the accountant, has to deduct the $5,000 for cleanup. They have a net profit of $4,000. An economist says not so much. An economist is going to say, actually, you have a loss of $8,000. Why is that? Because the $9,000 in revenue, you have to deduct from it the $5,000, which is the total cost, plus the $12,000 that is implicit. Therefore, we're deducting a total of $17,000. And this gives us a loss of $8,000. So if this company wanted to break even from an economic point of view to reach zero economic profit, they'd have to have had revenues of $17,000. Then you have 17,000 minus 17,000 equals zero. This is all in the outline. It's in your notes, so take a look at it for sure. But this is basically what it means. Now, a bit of a kind of quick visual. Economic profit versus accounting profit, and like when the S is not necessarily needed. Here's what you're looking at. This reminds me of like when I go get gas, of the gas pumps. I don't know about you, but here's what we're looking at. We're looking at implicit and explicit costs. So economic profit accounts for both. You see that? The revenues require all of that to be factored in. From an accounting point of view, it's just the explicit cost. What it's missing is the implicit cost. So this is just a visual to help you remember. So now we move down to fixed costs versus variable costs. All businesses have to contend with both varieties. On the left here, we have fixed costs. On the right, we have variable costs. What are fixed costs? Fixed costs don't change as the total number of units produced changes, meaning whether you produce 1 unit, 1,000 units, 1,000,000 units, that amount that you have to spend every month or every year remains the same. It doesn't alter with the level or the size of your operation. Even when you increase capacity, so long that capacity is running on only variable costs, it's not going to touch the fixed costs. So what are some examples? Mortgages, for instance, equipment that you might buy and be making specific payments on it, but it's always the same exact payment. The vehicles that the company has to purchase to deliver or to just drive around. The insurance, these are just some examples. So if you have to pay real estate insurance, or if you have to pay insurance based on a number of workers you have, or any other type of insuring your equipment, whatever the insurance might be, whether you're shut down and you produce nothing and you furlough everybody for 2 weeks and shut down the plant, or whether you're working 24/7 and upping the amount of units produced, it doesn't change any of these payments. So let's say a company spends $10,000 a year on insurance. Whether they produce 1 unit or 3,000 units, it's irrelevant. It doesn't change. It remains $10,000. The level of production won't change the price tag of 10,000 in total. So if they produce 1 unit, the fixed cost is 10,000. If they produce 3,000 units, the fixed cost is still 10,000. Contrast that to variable cost. So fixed means how much you have to pay per month or per year is not going to change with production. Variable is the opposite. It very much changes with production. So if you produce 0 units, your variable cost should be 0. And the more units you produce, the more you're going to see the variable cost rise. So variable costs do change. See, they change as total number of units produced changes. And they are things like utilities, supplies, raw materials, gasoline, wages. Think of what these things have in common. If you need to produce more units, you have to buy more raw materials. You have to buy, and when I say gasoline, like for instance, if you buy more vehicles here, or if you drive your vehicles around more and you put more miles on them, you're going to have to spend more gasoline on that. If you're hiring people overtime, or if you're hiring more people because you're having to produce more, that's going to vary. So they vary according to the quantity of production. Example. Let's say a company spends $2 in variable cost on product X. So per unit, this is always per unit. Okay, if this is not clear, definitely make sure that it's clear. Per unit. So the variable cost would be $2 for the first unit, but $6,000 for producing 3,000 units. You see how I said here to you, if it is one unit, it's still $10,000 in fixed cost. If it's 3,000 units, it's still $10,000. Well, that's not true here anymore. Because now you're like doing 1 times 2 is $2. 3,000 times $2 is $6,000. So the variable cost, I absolutely cannot catch many things until I sit down here to just discuss it with you guys. That's just awful, isn't it? So this is showing us that the variable cost very much changes as the number of units rises. It rises along with the units, it drops along with the units. One last thing I want to show you here, and that is the average total cost, the ATC. In economics, we don't use per unit cost. I know in finance is like the cousin who lives in another state and you kind of see them once a year, you know, for finance. Economics and finance don't necessarily agree on a lot of things. So per formula is very, very simple. It's the total cost of production divided by the quantity of units produced, like down here. Let's say we have total costs of production of $20,000. We are producing 5,000 units. Each unit is costing us $4. This is how much this company has to charge to break even. A price lower than $4, they lose money per unit. A price at $4, they just break even. They have to charge at least $4.01 to make a profit. Now, here's a little bit of a table. It doesn't correlate to this example, but I wanted to show you something very important. So take this company that's upping the number of units that it's producing. Notice how the total costs are always rising, right? The total costs are definitely why? Because each time you produce one more unit, you have to tag that cost of that unit onto the total. It's the marginal units, they change the total. It's always the way it works. But the average total cost doesn't behave like that. Now the average total cost here went from $8 for the first unit down to $5.50. Why is the first unit so much more expensive than the second and the third and the fourth? Because you're spreading, you're dividing that fixed cost down. The more, like see that $10,000, if you produce one unit, the fixed cost is $10,000 and the variable was 2. That means that first unit that you produce has an average total cost of $10,002. But the second unit is you're going to divide that 10,000 by 2, and you're still adding the $2, right? Because you have a variable cost of $2 per unit. So the second one is going to cost you $5,002 because you divided and now down to 4, to 6, etc. So you can see how as you divide it down, it's going to get smaller until you get to a certain level where marginal utility stops, not marginal utility, marginal analysis tells you, oh, wait a minute, see what's happening here? The law of increasing opportunity cost is coming into play. Maybe past unit number 7, the only way to produce more is to maybe get raw material from another supplier that's charging you more. Maybe you have to actually increase your fixed costs again. You have to purchase a new vehicle, you have to purchase new piece of equipment. So it could be over time you're paying. Something is changing about the structure of either the variable cost or the fixed cost that is actually making your prices rise again. So according to marginal analysis, units number 7 is the ideal number of units to produce before this company needs to shift resources to another product that hopefully has a rising price. This is where that 7th non-price determinant of supply comes in, where a company diversifies it and produces other units and moves resources to them as their prices rise. So in this case, it's possible that this company needs to find something else to put its resources in, and hopefully it's the other product they have, one of the other products that has, in fact, a higher price. So this is some of the concepts that we've learned before coming together. Okay guys, you have a wonderful rest of your day as promised. This is only 2 videos for this chapter, but don't hold your breath for the next one. Chapter 8 definitely has more than 2. Have a great one. I'll see you in chapter 8 or online before that.